Hey folks, and welcome back. This is video 2 in our series of videos. And we're going to talk now a little bit more about liquidity. So in the previous video, we talk a little bit about what it is technically. So you have different levels of liquidity. You have thin liquidity, you have thick liquidity, and so on and so forth. And now we're going to have a look at what thin liquidity looks like. Okay, so an illiquid market or an illiquid time of day, and we're also going to look at liquid times of day. Okay, because this is really interesting for us to understand. Okay, so if we look at this currency pair here, this is the Euro British Pound, and so when there's talk of liquid times of the day and liquid times of the day, what does that actually mean? Well, due to the fact that the retail FX market is a decentralized market, it's very difficult to get real volume information. But a study was done that confirmed that the tick data, so the number of buyers relative to the number of sellers in the form of volume, if we just turn that on here, volume, there it is. So the data that you can see here gives us about a 90% accurate reading as to what the real readings are for volume for this currency pair, and that's a pretty good hit rate. And while it's not completely accurate, it gives you a very good indication as to what's going on. Okay, and why I don't look so much at volume, you can see pretty clearly when you have a low volume periods and high volume periods, and this is typically related to the time of day. So if we enable this, where we have the period separators, now we can see the different times of day. Low times of the day are typically going to be between sessions. Okay, so between sessions is normally going to be where you have a dotted line. Okay, so this is the beginning of the day, the end of the day, beginning of the day, end of the day, beginning. Okay, and so you can see when you have the time between 2 days, then volume is going to be low, because people are going to be buying and selling less. Okay, and so in a situation like that, it's very good to know that it's not going to require terribly big orders in order to move price. In contrast to the middle of the day, when London is roaring and the European market is roaring, or the New York market is roaring, there is lots of volume being bought and sold constantly. And so it will require much bigger orders to move the market. Okay, and so typically if you're trading during very illiquid times of the day, you'll experience stuff like increased spreads, slippage, requotes, and so on and so forth. And so these aren't very attractive times of the day. And if we go look on the minute chart, because this is when we're going to really see what it looks like, let's go to an illiquid time of the day, which is here. Okay, notice here that price slowed down. We moved sideways. You can see we're moving sideways quite a lot here. Then all of a sudden, price gapped. Okay, and so there was a little bit of a discrepancy in price. And you can see here, this is early, very, very, very early Asia. This is early Asia, where you have kind of these wicks, like a lot of wicks, a lot of bars like this, where there's nothing really going on, where the open and the close are the same, so there's no fluctuations in price. There's zero volume, as we looked at in the previous video. Remember those periods of zero volume? And so if I was going to do something here, if I was going to sell here, price would gap all the way down here to fill my order. Okay, because there's literally no volume available at that price point during this time of the day. And you can see volume is very low. We go up a time frame. You can see it's very, very low in the beginning of the day, and it slowly picks up. And it happens the same way every day. Low, slowly picks up. Low, it slowly picks up. And so what does that mean? Well, that means that if we consider the areas of supply and demand that are interesting to us, and we talk about pancakes. Okay, so if you have a plate of pancakes that is formed during a very low volume of the time, low volume part of the day, time of the day, and with the quality of that plate of pancakes, or those pools of liquidity, are going to be much less. They're going to be smaller. in contrast to an area of supply or demand that is established when the London or the New York session are roaring, well, then the quality is going to be much better. And so how is that going to affect the way that we trade? Well, it should keep us on the sidelines when the market is closed. Why? Well, number one, we're going to have really wide spreads. So the spreads are going to be horrible. So it's going to be expensive to trade. Spreads. Number two, we're gonna experience much more slippage. And why is that? Well, that's because the liquidity is low. So just here, if we were here and we sold just here, we would have got filled on our order down here. That's a really bad price. Okay, so we sold, we had the intention of selling here, but we got a price, our order was filled at the price that was much lower than our desired entry price. Okay, and so that's just a really bad time of the day for this reason. Okay, and also we have this one here, we're going to get requotes. And what are requotes? Well, requotes are in a situation like this, you're going to be selling here, and what's going to happen is these are related, these two here. What's going to happen here is we're going to say we want to sell at 17. Okay, and I'm going to put in the order to sell, and my broker or my bank is going to say, now you can't sell at 17 because we don't have anything available at 17, but we'll sell to you at 14. And I can either say yes or no. And depending on the settings for my order, I will either accept it automatically and get filled at a much worse price, or my order will simply be rejected if I refuse to get into a trade where the slippage is greater than a certain value. Okay, this is a really nice thing to have in consideration, and this is why all of our algos they have the max spread setting built into the configuration, because if the robot is looking to get long or short during an illiquid time of the day, which we don't want, well then we want a way to prevent it from getting into the trade. Okay, and so if you reduce the spread to half a pip or a tenth of a pip, well then you're not going to get into trades in here during this time here, because the market conditions are so bad that filter will keep us out of the liquid poor times of the market. Okay, so that's what we have there. And so knowing this, I mean, looking at this area here, okay, this area here was actually formed during a really liquid time of the day. You can see here we have London. Actually, let's see. I don't want to be guessing here. Oh, I can't even see what that says. My eyes are failing a little bit. But this is probably, I'm guessing this is probably maybe European Open. Okay, European Open around here, and this is maybe the North American Open here. Okay, so this was formed at the Open of London. That means there is an enormous volume. At about 10 o'clock GMT, that is the most liquid time of the day. And so if you have areas of supply and demand that are formed and created, established during that period of time, the first hour or so of the Open of the New York or the European session, I mean, those are really good levels, because we know that if price leaves like that during the London or the New York session, then you know that is serious buying or selling, in this case selling. But if that happens here, I mean, here we had price gap down and then it went up. This is a price inefficiency. From this close to this open, this is a price inefficiency. So this is a very illiquid, a very poor time of day to trade. And we can expect prices, if price comes up, we can expect prices to revisit these lows, because this is a price inefficiency. So price will almost always return to the origin of this gap. Okay, if we have a look at another example, and we have this area here. This was created during the Open of whatever session it is, in New York maybe. So this is a really nice area. Okay, price left, huge volume. This is great. This is a very beautiful area of supply. Okay. Also, we have departure. We have this form during this very liquid time of the day. This is a heavy hitter. And let's try and find an example of another area that's created during Asia, and see how price reacts to it. Okay, look at this one here. This is very, very late in the day. This was created after the New York session closed. We started to get very, very thin here. Maybe the New York session closed around here, so volume liquidity is on the decline. This area is established. It did fulfill the rules that we have. We had a nice departure. We had area spent not a lot of time in the area. But what happened when price visited it? Okay, note this was established out of session. We have in session, so this is maybe very early London or very late Asia, a more liquid time of the day. Okay, and so the order flows during this time of the day was way greater than the order flows that were here that establishes area of demand. As such, price tears through it. Okay, this one on the other hand was created during the peak of the volume during the day. What happens when price gets to it? Bounce, bounce. That means that we have high volume, we have low volume. We have everything in here. This is very low volume. We have low volume. Do you trade it? You don't want to trade it. It worked, but you need rules to follow. Okay, this one worked barely. Okay, but you need rules to follow, and so you want to focus on areas of supply and demand that were created during very liquid times of the day. And I'm going to build this into the supply and demand software and all of our algos so that we don't have to think so much about this. But this is very interesting and very fascinating. This is a very fascinating study if you're into that kind of thing. If we zoom out a lot so we can get more rectangles on the chart, it'd be interesting just to go back in time and have a little look about what happened. Okay, so let's go back a little bit and let's look. Okay, we want to find areas that were established. Okay, we had this one here. Okay, huge departure during the peak of the day. Respect for it. Okay, we had this one here, which was created very, very early Asia. We had a small bounce and then price tore through it. We had this one here, which was created maybe around the London Open. It was tested several times before it was finally defeated by the flows late in the New York session that went through it. Okay, we have another example. We had this area here. I hope this this is kind of difficult to see, isn't it? I apologize. I'll zoom in one more time. Okay, we have this one here, which is created very early Asia, tested, tiny reaction. This area of supply tore through it. Okay, yeah, I think you guys get the point, but I just want you to understand that liquid times of the day are the best times of the day to trade, and areas of supply and demand created and formed, established during these liquid times of the day are higher probability than those created during illiquid times of the day. So between the North American and the Asian session, or between the days, you do not want to trade areas of supply and demand that are formed within this this time window. This is a really, really bad idea. Good. Well, I'm going to leave it at that. I'm going to try and keep these videos pretty short, 10-15 minutes each. Then we'll just do many more of them. But I hope this video helped clarify a few points. Number one, liquidity. Liquidity is everything. That's all we have to work with. All we need to focus on is the presence or the absence of liquidity in a marketplace, and how this presence or absence is affecting the behavior of price. As my mentor would always say, volatility is a function of available liquidity. And this is absolutely true. Volatility, how price moves, if it moves up and down very, very quickly, is a function of available liquidity. If liquidity available is very, very low, then the volatility is going to increase. I hope you understand why. And if the volume is high, the volatility of price is gonna tighten a little bit. It's going to get a little bit smaller. Why? Because it'll require bigger orders to push price higher and bigger orders to push price lower. Okay, good. I'm going to leave it at that for now. If you have any questions, let me know, and I'll see you in the next video.